Welcome to Equity Mates. My name is Bryce, and as always, I'm joined by my equity mate, Alec. How are you going?
I'm very good, Bryce. Looking forward to this episode.
Absolutely. Something that we've learned on our journey of investing is that understanding the macro environment is perhaps one of the most important things that will really help you understand, I guess, the intricacies of your company and how they are really operating. Understanding how the economy works is important, but also tough, isn't it, Ren?
It is. It's a whole different world out there when you're talking about the macroeconomic world. We could try and talk to you about it for a while, but we've got an expert on this episode to talk us through it, some of the things he's watching. No time like the present.
Yeah.
Should we introduce him in?
Absolutely. So we are excited to be bringing our, I would say, in-house economist. We've got Thomas on the line who will be joining us. He is from the podcast Comedian vs. Economist, where he sits down with his brother Adam, who is a comedian, to help unpack the world of the big bad economy in a way that is certainly digestible and also funny. But Thomas, it is our pleasure to welcome you to the show.
Yeah, thanks, guys. Yeah, if you want to do up a business card that says Equity Mates Chief Economist, I'm happy to rock that.
We're going to hold you to that.
Yeah, absolutely. Next time you're on, watch this space. So Thomas, as we sort of said in the intro there is a lot going on in the world of macroeconomics at the moment. We've got the Fed going on a printing spree. We've got the China trade war, or the America-China tension. We've got record low interest rates, the potential for inflation. There's just so much to sort of unpack and understand. Firstly, what is sort of front of mind for you going into 2021?
Yeah, I kind of think the key issue is the shape of the recovery. So when COVID hit, we knew we were in for a rough time of things. We knew on all the metrics that mattered, whether it's GDP or employment, that things were going to get rough for a while. The question very quickly became, what kind of recovery were we going to get? Were we going to get a V-shaped recovery? Were we going to get a U-shaped recovery where it sort of tracks sideways for a while? Was it going to be L-shaped with no recovery? Was it going to be S-shaped where we bend space-time for a bit? In the Australian context, it's increasingly seeming like we're getting a V-shaped recovery. So if you look at on most of the measures, there were big falls. It was sharp. It was a very steep drop, but we've come back much more quickly, and much more quickly than I think most economists were predicting, and more quickly than the RBA was predicting. And so that's a good news story for Australia in particular. There's still a lot of challenges, globally with COVID still, rocking our major trading partners. The China story, China's our biggest trading partner. It's them first and daylight second. And that situation's very fluid, and that has going to have a big impact on the outlook for a lot of sectors exposed to China. So that's a big story too. But on the whole, you'd have to be thinking that things are looking pretty good in the Australian context, that we're on track for a V-shaped recovery. And given the amount of stimulus that's come into the pipeline and how much money's been thrown at the economy, you got to be thinking that policymakers might be thinking that they've overcooked things a bit. They might have thrown a bit too much money at the economy. And that's going to be good news. If that's true, that's going to be good news for the cyclical sectors.
Yeah, we've seen some phenomenal results from retailers of late, so there's definitely a lot of money in the system and people are finding ways to spend it. But Thomas, you're an economist, and although we are equity mates, whenever we have an economist on, the first question has to be around property. Australians love property. So do you have any thoughts on what 2021 will have for the property market?
I think it's going to shape as a pretty good year in terms of price growth. Again, property is another case where the falls were pretty marginal in the scheme of things. On CoreLogic's measures, we didn't even sort of drop 5% before we started to turn things around. Some of the other data publishers are even posting better results. So at some point people were talking about 40% falls in the property market. We didn't come anything close to that. And so we're entering 2021 in a pretty solid space. There wasn't a rush for the exit, so people weren't looking to offload property in any sort of meaningful way. The deferrals on mortgages really helped that. So we didn't see any panic selling. Everyone kept their heads. The market was steady. But at the same time, you've got record low interest rates. You've got the term funding facility out of the RBA, which is making super cheap fixed rate mortgages possible. So you're now seeing fixed rate mortgages with a 1 in front of them. Yeah, and as a result, like the downturn is really mild in the scheme of things. Like it's barely a blip on the radar. We're still lower than we were in 2017, so that's worth remembering in an affordability sense. You can see on this chart here that we had the downturn that started in 2017 with the APRA restrictions sort of clamping down on credit. That didn't fully unwind before we saw the COVID dip kick in, which is pretty mild there. That's that dotted line there. So prices are still lower at a sort of median capital city average than they were 3 years ago. So we're not looking at it sort of being expensive or bubbly just yet. You know, it's hard to make the case that it's bubbly now if we're still lower than where we were 3 years ago. So the market's sort of steady. It's looking pretty solid. Record low interest rates fueling sort of property demand. Yeah, and you know, really, it's interest rates are the primary determinant of house prices. We know that RBA has published, you know, research on this saying it's the main factor. And so when you've had, you know, interest rates falling from sort of around 4 to 2%, which they have if you're including the pivot to fixed rates from variable rates, then you're talking about a huge reduction in interest rates, and that's going to create house price inflation. We know that's going to happen. The question becomes how much, and it's an open question. The RBA got pinged with a Freedom of Information request earlier in the month, and their internal analysis said that they expect that the kind of interest rate reductions that we've seen are going to lead to house prices increasing 30% over 3 years.
Over 3 years, I mean, I read in the paper not too long ago that Byron Bay, kind of up your way, was experiencing house price growth of 40% in the last 6 months. So, I mean, I think the RBA need to check their facts a bit there. But not good news for Ren and I who are not in the property market. Not going to be good.
Well, it may be good news if you're in the capital cities. That's the other thing that's been interesting about the property market since COVID is we've seen a pivot from the capital cities, particularly the apartment market, to the regional areas. And that dynamic, you know, up in here in Byron, that's going to have a big impact. We're seeing that having a big impact. But if you're looking to get into the capital city market, you know, maybe it's not a bad time to buy.
Now, Thomas, we're talking about house price inflation there and record low interest rates. What about inflation more generally across the economy? How are you thinking about that? Is that something we might see in 2021?
At the moment, it seems pretty contained. I'm not seeing a lot of analysts particularly worried about it. That said, we are seeing some sectors of the CPI, the Consumer Price Index, starting to pick up. Like furniture prices are starting to accelerate for some reason. I'm not totally sure what's happening there. But, you know, there have definitely been some supply chain disruptions. The China story is going to feed into that as well. So you might start to see that causing some consumer price inflation in the medium term. It's not shaping as an issue this year, and it really doesn't seem like the RBA is particularly worried about it at this stage. The RBA seems to be saying that they're much more interested in employment and what's happening in the labour market and what's happening to the unemployment rate, and they're going to keep things rolling pretty easy, keep things pretty liquid until they get an unemployment rate somewhere in the 4s, the 4 point something. You know, and that's fairly ambitious given we're around 6.6% now unemployment rate. You know, there's a lot of room there to run. And Guy Debelle was saying the other day, he thinks they're happy for now to err on the side of looseness rather than tightness. So I'm mangling that quote, but it was something to that effect. So they're not particularly worried about inflation for the moment, but we are seeing some signs, and you know there is a supply shock in place with COVID. So how that plays out is something that we'll need to watch.
So let's move to unemployment. Obviously a lot going on in terms of stimulus here in Australia and also over in the States as well, and you would assume that a lot of that is supporting employment here in Australia at the moment. How does the current level of unemployment compare to, say, past recessions that we've experienced?
Yeah, it's still pretty mild in the scheme of things, 6.6%. You know, for a long time, back when I was doing my studies, we used to think about 5% employment being full employment. So you're not really going to get much better out of the labour market than 5%, something around that mark. Yeah, so 6.6%, that's pretty decent in the scheme of things. That's been held down by the JobKeeper packages and the programs that sort of that incorporated. But what we have seen, which is interesting, and we've got a chart here on the underemployment rate, which includes people who have a job, they have a job, but they're looking for more hours. And we saw that spike quite substantially with COVID, but that's come right back down now. And that's back to levels it was pre-COVID. So there's the underemployment shock has worked its way completely out of the system now. And that's a bit surprising, but it suggests that the labour market is much stronger than we expected it to be at this stage in the game. In partly that's driven by the pivot from full-time to part-time employment. So while employment is lower than total employment is lower than it was pre-COVID, if you look at part-time employment, I think I've got a bar chart here comparing the two. You look at part-time employment, the red bars, they're back in the black now. So part-time employment is higher than it was pre-COVID. So what the story here is that the labour market has kind of managed the shock by transitioning away from full-time employment. Firms wound back their employment a bit and moved from full-time to part-time employment. Average part-time employers went up, so we're working our part-time workers harder. But that's how firms have managed the shock. And with sort of the economy coming back online, things getting back to normal, it's looking pretty good. And it's another case of a V-shaped recovery. I think maybe there's a chart here where we compare employment to past experiences, past recessions. Yeah, you can see here, and that blue line's bounced right back, and now we're barely 1% lower than we were pre-COVID in terms of total employment. So it seems to be, that's much better than I think everyone was expecting. I don't think anyone expected the profile to look like that in the early stages of COVID. But here we are with the employment market doing pretty well in the scheme of things. And with the sort of the money that's coming on through government support packages, that's supporting the household sector to be pretty flush with cash, and that's going to support retail spending. We're already seeing it support retail spending, which is obviously bullish for the retail sector.
So Thomas, as the chief economist at Equity Mates, you know we love a bold prediction, and we want to get some from you before we wrap up. But before then, I just want to put a little bit of a bow on everything you've been telling us today. It feels like pretty positive news. It feels like employment is rebounding. It feels like JobKeeper has sort of meant that people are flush with cash. You talked about a V-shaped recovery. You spoke about house prices being up 30%, which is making most of Australia run out in the streets in celebration. Is that a fair takeaway, that things are looking okay from a macroeconomic perspective as we get into 2021?
Yeah, I think that is a fair assessment of things. I mean, it's, consumer confidence is higher now than it was pre-COVID. But there's still, which is sort of surprising given the shock, but the kind of argument there is that everyone thinks, well, it could have been a lot worse. And given what's happened, and given that there's still lockdowns coming up here and there, given that our major trading partners, particularly the US, are still struggling with COVID, we're doing pretty well. Australia's sitting pretty in the scheme of things. And it's a good news story for now. I think COVID definitely wasn't the disaster we expected it to be, and we're still in a recovery. We're not there yet. We're on the road back, but we're doing much better than I think everyone was expecting.
So Thomas, to close out the segment, as Ren said, we do love a bit of a bold prediction here on Equity Mates, and you've got 4 here, so we might sort of run through them. One of them I'm particularly interested in, given one of my bold predictions for 2021. But let's start with the housing market. Bold prediction. What can we expect?
I think you're going to see house price growth at the median capital city level. I think we're going to get over 10% this year. I think that's pretty likely. Maybe 12%, something like that. But I think we're going to see the pivot to the regional areas. That's going to continue, and I expect some major regional centre will see growth plus 30% sometime this year. That's my bold prediction.
Go Wagga Wagga.
Yeah.
Well, given you're based near Byron, Thomas, I'm sure you're hoping that's the regional area that gets the 30%.
Yeah, we're giving it a nudge already.
Yeah. Now, sticking on the housing theme, you have another bold prediction related to housing and around mortgages.
Yeah, I think we're going to see fixed rate mortgages sub 2% as standard from the major lenders this
Wow.
year.
Crazy.
I think that's sort of coming out of the RBA's term funding facility. It's not likely that they're going to wind that back anytime soon. And so I think, we're already sort of seeing it as a special honeymoon rate. I think it could be the standard sometime this year, particularly if COVID globally plays out a little worse than we thought we're expecting.
So Thomas, you've got one here about Bitcoin. I will front run this by saying that my bold prediction for 2021 for Bitcoin was that it will shoot past 90,000 USD. This is where we will leave it. And what is your bold prediction for Bitcoin?
I'm calling Bitcoin to 5,000 USD. I'm a Bitcoin bear. I think it's going to go in two legs. I think we'll go down to the 2017 highs of 18,000 slowly, a slow meltdown, and then a very quick run once we break that down to 5,000. I still don't think that there's a great use case for Bitcoin. I think there's a lot of competitors for Bitcoin. I don't see a road to global dominance, even if you're bullish crypto. I don't know that you'd be necessarily bullish Bitcoin. So that's my thought.
We'll take this one offline, but no.
I'm gonna pull Bryce out there because otherwise we'll have a full-blown argument in the few remaining minutes. But instead, I want to turn overseas, and Bryce and I have been joking that a lot of the episodes we've done on this show so far have been focused on US tech, and that's not deliberate. That's just because that's where a lot of the action is these days. Your last bold prediction is around that US tech theme. So tell us what you think is going to play out in 2021.
Yeah, my bold prediction is I expect the US Congress to take meaningful action on breaking up big tech. I feel like some of the political barriers to that are overturned now with the Biden administration coming in. I think the Republicans are going to be licking their wounds post the capital city riots. I think a lot of that, really rabid base is really anti-big tech as well, particularly in the way that Twitter banned Donald Trump. So I feel like there's not a lot of political opposition to breaking up big tech, and the Democrats have been talking about this for a while. So I expect I'm not sure exactly what it will look like, but I think we'll see the ball start to roll this year. I also think we might lose Google search from Australia. That's another bold prediction.
Well, we did speak about that this week, so we'll see how that plays out, but certainly one to watch. But Thomas, it has been a lot of fun having you on the show, your very first appearance on Equity Mates TV, so thank you very much. We look forward to having you on throughout the year for our macro update. As we said, it's a pretty important concept to understand, so thank you.
Yeah, thanks for having me, guys.
And that brings us to the end of Equity Mates for today. It has been an absolute pleasure. We've had a great time. We hope you have been able to get something out of our conversation with Thomas that will help you on your investing journey. And if you would like any more information on Comedian v Economist, which is the podcast that Thomas is on, or on Equity Mates, head to equitymates.com for more information. But Ren, looking forward to a big week next week.
Yeah, can't wait. And if there's any business card makers out there that want to make that Thomas, Chief Economist of Equity Mates, hit us up at equitymates.com. Would love to take you up on that.
Until then, have a great rest of your week, and we will see you on Monday for another week of Equity Mates.